So when I first saw this cartoon, it made me laugh. But in reality, it does a great job of depicting the current market psychology, which is that the underpinnings are quite positive, but investors, there's a palpable nervousness and anxiety amongst investors. And I'll get to that in a few moments. And actually, after today, after I look at this slide a little bit more, it looks like a nice population of future dry eye patients. So from an equity capital markets perspective, it's really been a tale of perception and reality. The perception has been that the recent run-up in the stock price was driven by the election. They call it the Trump trade, Trumponomics, the Trump bounce. If you're on the other side of the table, the Trumpocalypse. But when you really look at it, it really started with improving economic trends. And the chart on the right basically shows economic data relative to expectations. So the higher it is, the more of a surprise it was. And you can see back in April, there was a nice inflection point where economic news were coming in better than expected, but you didn't see a corresponding increase in the market. You only saw that later in the year. So I think it's more accurate to say that the election enabled the underlying economic data to be more reflected in current stock prices. In addition to positive leading economic data, and it's not all good, right? You know, my sort of view is it's not about good or bad, it's more or less about better or worse. So economic data tend to be more better than it is worse. But a nice tailwind has been corporate earnings. We saw earnings growth turn positive late last year, and into the first quarter of this year, growth was clocking in at 12.5%, which is a really nice year-over-year growth rate. Interest rates on the right remain at historical lows. That is conducive for equities. I will say the flattish sort of nature of the yield curve is a little worrisome. The debt markets tend to be a lot better about predicting economic performance than equities. But I will say, on the flip side, that given the geopolitical concerns, I think there's been a flight to safety amongst, at least on the long end of the curve, and that sort of artificially has lowered the curve. So probably would have been a little more steep than it's looking. So more or less a positive indicator as well. Going back to my dry eye cartoon at the outset in terms of the anxiety and nervousness, there's a number of ways of sort of gauging psychology in the market. Real quickly, this one here is the CBOE skew index. It basically just measures tail risk. Said another way, you know, how much do investors believe there's going to be a significant move up or down in the next 30 days? The number's typically around 6, 7, 8%. We've seen it as high as 15% recently, again, underscoring the sort of underbelly of nervousness in the market. Shifting the attention to the medical device index, again, this is med tech companies, no biotech, it's equal weighted. You continue to see outperformance in med tech. Lots of reasons driving it. In the interest of time today, I'll just point out regulation. As Gil mentioned in his discussion this morning, Dr. Gottlieb, I think, is being seen as being pro-innovation, which is a good thing for all of us in the room here today. When you peel back the layers a little bit of this performance, you can see that's really being driven by the small cap companies. I think, again, good for all of us in the room. That's where usually most of the innovation is happening and where investors have been flocking to achieve outperformance. Specifically as it relates to ophthalmology, that continues a lot of trends that we've seen over the past couple of years, a lot of positive drivers that has resulted in this performance. Probably most notably, again, as a theme we've heard today, is active M&A. There continues to be a real sort of a nice bid, if you will, M&A bid to the valuations in this sector. Scarcity value, there's really not a lot of publicly traded ophthalmology companies, so investor dollars are not really spread over that many names. And then finally, you know, we're all here today at OIS, and we witness the innovation and the technology that's going on. And it's a really nice intersection between innovation and commercial opportunity. And I think we're all living in a renaissance as it relates to this sector, and that continues to provide nice currents to the sector. M&A continues to be the predominant exit mode from a venture capital and private equity perspective. You see dramatically more M&A transactions than IPO transactions. That's likely going to continue to be the case. The IPO product tends to be very selective. There's a handful of companies that have the criteria to go public. When you go back and look at the performance over the last couple of years, it hasn't been that great, so we need to see better performance in the IPO market before that product becomes more widely available. In ophthalmology, the trends there in M&A really mirror that we're seeing in the broader med tech market as well. A lot of M&A, not a lot of IPOs. I will point out what's helping M&A more so now is sort of a willingness to use more innovative deal structures. to bridge gaps in valuation and perceived risk. And I think that's also a nice driver of M&A going forward, particularly in ophthalmology. So I am out of time. I didn't get the hook yet. I'll just say in the closing couple of seconds I have, all in all, we remain pretty positive on the ophthalmology sector. This conference is proof and point of the fantastic innovation that's going on, and public market investors are recognizing that and how they're looking at the sector. So with that, thank you very much. I was happy to be here today.